Okay, let's kick off. Welcome everybody to this morning's webinar on the economic outlook, implications for media M&A activity in 2025. And this is the latest in our series of Selling Your Business webinars. So my name's Esther, I'm a partner at MKS, and I'm going to do a bit of light chairing this morning. It's great to see so many of you logged on. We've still got a few clicking in at the minute. Lots of regulars to these webinars, but there will inevitably be some of you that haven't logged on before. So for those of you who aren't quite so familiar with Moore Kingston Smith, we're a firm of top 10 firm of accountants, tax and corporate finance advisors, working with clients and businesses across all different entrepreneurial sectors, as well as not-for-profit and private clients. And in our West End office, we have a team of 9 partners and around 100 staff who specialise exclusively in working with media, entertainment and marketing services clients. And we also have a media specialist corporate finance team who specialise in M&A, in particular on sell-side advisory, taking sellers through the entire sales process. They also offer strategic growth services, helping clients get into shape ahead of a sale and to ultimately maximise their value on an exit. And also financial due diligence as well. So acting for a number of strategic trade acquirers, as well as private equity houses in the space. And over the summer, our M&A team have completed 8 transactions, including the sale of Total Media to Service Plan Group's Media Plus, as well as advising on the sale of New Commercial Arts Group to WPP. And we're also part of More Global Network, international network, which consists of around 100 firms across lots of different countries. And we regularly team up with our colleagues around the world to assist on cross-border matters and support clients generally on their international growth aspirations. So today we will be looking at the impact the economy is having on the media M&A landscape and looking at the market for 2025. And we'll of course discuss the forthcoming budget. And we'll hear about the latest forecast for the economy and then discuss what we're hearing from acquirers, investors and agency owners, as well as what we're seeing on transactions. So I'm delighted to be joined by Baldwin Bippus, European economist at Barclays Investment Bank, Fraser Bars, Head of Media at Barclays Corporate Banking, Emily Hickley, Investment Director at Horizon Capital LLP, who will join my colleagues from Moore Kingston Smith, Paul Winterflood, who is our Media M&A partner, and Mel Reid, who is one of our M&A tax partners, for what I'm sure will be an incredibly insightful hour, as they'll give their perspective on what they are seeing at the moment. So a couple of housekeeping points before we start. This is being recorded, so please do share with any of your colleagues who were unable to make it this morning. This is your webinar. We're keen to have a lively conversation, so please do post some questions in the Q&A function, not the chat function. I can keep track of them in the Q&A function much easier, and I will then seek to weave those questions into the questions that I've got for the panel. And lastly, we're always keen to hear your thoughts and suggestions on future webinars, so please do fill out the feedback form that we will share with you at the end of this webinar. So firstly, we are going to hear from Baldwin Bippus, who will give us an overview of the economic outlook. Baldwin is a macro researcher on the European Economics Research Team at Barclays Bank. And prior to that, he worked at the European Central Bank and the Bank of England. He has a PhD in economics from the University of Cambridge, where he specialised in international macroeconomics and finance, nonetheless. And Baldwin also has a few other academic titles that I won't embarrass him with. So Baldwin, if you want to turn your screen on, oh, and don't forget to unmute, then it's over to you.
Hey, good morning. Let me just try to share my screen with some slides. Okay, great. So good morning, everyone. I'm excited to give you an overview of how we at Barclays see the economic outlook for the Euro area and the United Kingdom going into 2025. I want to start with a few words on the Euro area, and then I'll get to the United Kingdom. So let me start with the Euro area. So essentially, when we look at economic activity in the Euro area, we see a picture of broad stagnation. So in the chart on the left-hand side, I show you the how GDP growth has looked like since the pandemic. And you essentially see that there's not been a lot of growth, and that kind of economic activity is below where we would estimate potential activity. And that if we kind of judge economic growth compared to the kind of pre-pandemic trend, then we are now not even half where we should be, and we kind of expect this gap to only grow going into 2025. And so why is that? Well, so if when we look at the components of GDP, we see that there's essentially weakness in both investment and a rebound in consumption that has been much slower than we have hoped. Now, why is that? Well, so here one of the big factors are interest rates, which are still very high, and so that raises the cost of finance for and therefore prevents kind of investment, but it also prevents kind of a rebound in consumption. And actually, some of the growth that we've seen over the last few quarters in the euro area was also due to net exports, which we think is not as persistent, and actually the more underlying parts of economic activity like consumption are not looking that great, and therefore we think that economic activity going forward is also only going to grow very slowly. So to give you some numbers on this, so we think that economic growth in 2024 will be 0.7%, and then it will only go up to 1% in 2025. So really very low growth. And then also kind of under the hood, there's a lot of divergence across regions and industries. So we see that particularly manufacturing is still struggling a lot, and we see that particularly Germany, then kind of geographically, is really lagging behind. Now, kind of to give you some more flavor, particularly on the consumption side in the euro area, I wanted to show you these two charts. So here on the left-hand side, you see how excess household bank deposits have developed, and you see they've kind of really were built up during the pandemic, and then slowly run down after the pandemic, and they are now exhausted. So essentially, there are no excess bank deposits left anymore for households, and so we cannot really expect a push for consumption growth coming from there. Now, at the same time, what we've also seen since the pandemic is that saving rates have gone up a lot. So essentially in all of the major European countries and also in the euro area overall, saving rates now are significantly above where they were prior to the pandemic. And so this, of course, also kind of slows down economic growth. Now, here we also think, I mean, one of the factors is clearly economic uncertainty and uncertainty in the labor market, for example, but it's also, again, high interest rates, which make people put their money in their bank account and not spend on big items. So that kind of brings us to the question, what can we expect for interest rates going forward? And this is essentially one of the key questions also for the economic outlook going ahead. And so here is what the ECB will look at when judging what to do with interest rates. It's really inflation. So I want to give you a very quick view on how we see inflation in the euro area. So on the left-hand side, I'm plotting the contributions of inflation, which has really come down a lot since the height in the pandemic. And you see that by now, inflation is basically all services inflation. Now, is that an issue? But it's already come down a lot. Now, is this kind of still high service inflation an issue? So here we think, I mean, it is still an issue, but we don't think it will really prevent the ECB from cutting interest rates going forward for two reasons. One is that we think that service inflation itself will go down because of wage growth, and we judge this based on negotiated wages, which we look at in detail. Kind of wage growth is already coming down, or has peaked in many countries, or will soon peak in many countries, and so we think that due to that, service inflation will now come down as well. And then the other parts of the kind of consumption basket are not showing high inflation rates, and particularly energy is very, very deflationary right now. So oil prices have been falling a lot, also gas and electricity prices are low. So kind of there's a lot of energy deflation right now, which also pushes down inflation. And so due to that, we really think the ECB is now in a position where it has kind of built up enough confidence to continue with the easing cycle. And so we expect cuts at every meeting from now until June for a terminal rate of 2% in the summer of 2025. And so we think this should kind of help economic growth a little bit, although due to the factors I showed you before, we still think that growth is gonna stay depressingly low in the euro area. Now let me come to the United Kingdom and give you some ideas of how we think about the economy there. So the United Kingdom has had a technical recession in the second half of 2023, but has rebounded quite forcefully from that with very high growth rates so far in 2024. However, we think that when we look at the underlying dynamics, we think that they're not as great as the kind of headline growth numbers suggest. In particular, a lot of the growth that we've seen so far in 2024 has been coming from, again, net exports like in the euro area, but also changes in inventories. And so these are the parts of kind of economic activity that are not as persistent, right? And therefore, we don't think they will persist in the future. And kind of going into 2025, growth will more come from consumption, but there it will be it will not be, as strong as we would need to keep up the high growth rates we had so far. Kind of to bring this point home, I also on the right-hand side want to show you some different indicators that are indicators for consumer confidence service. And you see that, I mean, overall, they've bounced back quite a lot over the recent year, but they're still at relatively low levels compared to where they were historically. So, and then kind of most recent prints were also not that great. So kind of all of this to us indicates there's going to be some consumption growth, but not a great deal. Now, let me come to kind of the inflation and rates outlook for the United Kingdom. So on the inflation side, it's actually comparable to what I showed you in the euro area, in the sense that inflation now is mostly services inflation, which we think should moderate in the United Kingdom as well, based because kind of we see a cooling of the labor market, and we also see that the measurements of wage growth that we have been coming down. So we think that service inflation will come down. And then also in the United Kingdom, there's going to be very deflationary effects coming from energy. And so putting those things together, we think that inflation is going to fall going forward, and is also going to put the Bank of England into a position to continue the rate cutting cycle. And so here, kind of our house view is that they're going to cut rates for a terminal rate of 3.75 next summer, and that should then also kind of help investment and consumption recover somewhat. So kind of there was. Let me maybe say some more on our outlook for the United Kingdom and how we think the economy is going to evolve. So we think kind of if we look relatively at the economies, the United Kingdom is doing somewhat better than the euro area, and it's going to grow a little bit more than the euro area, although inflation is still somewhat higher in the UK.
Mm-hmm.
And we think, later today we're going to talk a little bit about the budget, which of course still adds some uncertainty to the picture. But we think overall one of the strengths of the United Kingdom right now is that actually the period of kind of uncertainty with the election, with political risk is somewhat behind us. So there's also, when we think about the US, right, the US is going to have their election. All of these things have happened in the United Kingdom. So there we think actually going forward there's going to be a lot less uncertainty and hopefully somewhat stability in the United Kingdom. Okay, so this was basically my overview of our outlook, and I'm happy to discuss more in detail later in the panel discussion. Thanks.
Thank you very much, Baldwin. Next, we're going to hear from Paul Winterflood. He is a media M&A partner at Moore Kingston Smith, and he's going to update us on the M&A activity within the sector. Do watch out, actually, for our full quarterly M&A report, which should be landing in your inboxes in a couple of weeks, which goes into quite a bit more detail about the different key subsectors of interest for investors and the notable deals. And obviously that will update for Q3. So over to you, Paul.
Excellent. Thank you very much, Esther, and good morning, everyone. So you've heard the current economic backdrop, what I'm now going to do is set the scene with some of the things that we're seeing going on in the media M&A market. We're going to look at what's going on in the sector from a deal completion perspective, and then later in the panel discussion, we'll be looking more at the outlook for the sector. Just briefly, for those of you that haven't joined before, we record all transactions involving either a UK buyer or a UK seller in the media and marketing services sectors, and that's what we use for the basis of our analysis. So, firstly, just starting off with deal volumes. So, I think heading into 2024, everybody hoped that it would be a significantly stronger market, both in terms of client spend in the media marketing services space, as well as with M&A activity. And whilst there's been an uptick in the number of deals in Q3 relative to Q2, if we compare the performance of 2024 to the last couple of financial years, or the last couple of years, you can see that every single quarter is still down on the equivalent 2 years, and so I'd say it's still quite a tough market currently from an M&A perspective, and that's very much linked to the conditions in the general economy. I think that whilst I think there's been a more positive numbers reported from a growth perspective in Q1, I still think the economic recovery has been slower to kick in, and that certainly has had an impact on client spend in particular. The video game sectors, and in particular the TV sector, have had a particularly challenging 6 months, and that definitely impacts deals. Looking forward to this quarter and what's going on at the moment, Esther mentioned the budget, which is coming up on the 30th of October. At the moment, that's driving through activity as sellers are wanting to transact and complete deals prior to the 30th of October. That's likely to lead to a spike in numbers in the next quarter. But Mel's going to discuss more about the more sort of medium-term impact on that shortly. One of the areas we've seen a decrease in activity in this year has been with deals involving private equity. So post 2019, the portion of deals in the media and marketing services sectors which have had private equity involvement, either directly or indirectly, have been in excess of 50%. If you look at the chart on the right, you can see that 2024, whilst it's the absolute, whilst the drop is only from 58% in 2022 to say 45, 46% in 2024, that's still it's still a significant portion of the market where there's less activity. For those of you who attended our previous webinars, I think you'll have heard that we don't see the appetite for private equity interest in this space to drop at any point. What we have seen over the last couple of years, though, is that higher interest rates are meaning that transactions are harder to put together, and one thing we have seen is that the valuations desired by founders aren't necessarily being met at the current interest rate levels in sort of debt-backed deals, and so as a result, we've seen a reduction in activity. In the marketing services space in particular, we are expecting a number of secondary transactions over the next couple of years. That's where a business which is backed by private equity sells to another private equity house or sells to a trade buyer. There's been a few over the last couple of years, the likes of MSQ and Brain Labs, but we're expecting quite a few more of them in the next 12 months, which we expect to then kick off a further round of acquisitions, assuming that the tax environment is not too unfavourable. So I think despite the downturn in numbers that we're showing here in 2024, private equity still makes up a high proportion of deals. They're here to stay, and they will help support transactions going into the future. Now moving on to capabilities. So these are from the marketing services sector. This shows what has been in demand from acquirers over the last quarter. We've talked a lot about social data and analytics in previous webinars, previous reports. They absolutely remain high on acquirers' wish lists as marketing spend moves from offline to data-driven digital interactions, and we expect that shift to continue. The yellow segment of the chart is one that we haven't necessarily touched on that much in previous webinars, and that's experiential and events, and that's definitely a sought after area by acquirers. I think that there's been a post-COVID, since the events industry has now recovered, there's now demand for fewer but higher quality events, as brands look to interact with consumers in meaningful, high impact ways. The final one I'll just touch on briefly is creative. High quality creative remains sought after despite the speed of change in the sector. Additionally, we've always remarked that great deals get done regardless of the macroeconomic backdrop. I think the new commercial arts deal is another of those, which is a really significant deal for the sector. In our last webinar, which was on the impact of AI on the sector, and watch that back if you haven't already seen it. We talked about the impact that AI was likely to have on M&A activity going into the future, and we expect it to drive significant investment and acquisition activity. And AI was and the impact of it was cited as one of the key reasons for the transaction. And new commercial arts having access to WPP's firepower and investment in data and AI is going to help them continue to grow over the coming period. So that's definitely something to note. So I think in summary, it's definitely a tougher market at the moment, and deal numbers are down, particularly for larger deals. For businesses trading well, though, there are still lots of well-funded acquirers, but the macro and client situation and client spend situation is definitely meaning that it's a tougher market and harder to put deals together. And that's certainly a topic we'll discuss in more detail in a moment. So I'll hand back to Esther now.
Thank you very much, Paul. So I'm delighted that Paul and Valdwin will now be joined by Emily Hickley, Fraser Bars and Mel Reid. So if you want to turn your cameras on. Mel is an M&A tax partner at Moore Kingston Smith and works very closely with Paul and I on deals in the media space, and has advised on numerous sales, MBOs and private equity investments over the last few years. Emily is an investment director at Horizon Capital. She focuses on sourcing and executing both new deals as well as strategic add-on acquisitions. And prior to Horizon Capital, she spent 6 years providing debt capital for private equity transactions across the UK and Western Europe at the Royal Bank of Scotland. Fraser is head of media at Barclays Corporate Banking. He leads a team of directors working with some of the UK's largest and most exciting businesses across content, video games, publishing and marketing services. And Fraser has been with Barclays for 15 years. So I have some questions for the panelists, but like I said at the beginning of this webinar, please do join in. Please do pose some questions of your own in the Q&A function, and then I will weave those into the panel as we go along. Okay, so I guess starting with sort of maybe Fraser and Emily first, just make sure you've all got your microphones on. How are your clients and your portfolio, Emily, in the media sector finding the current economic climate?
So I think it's echoing a lot of what both Paul and Baldwin have said this morning. It's not been easy. It's definitely been a tough environment, and there's no way of shying away from that. I think things have definitely been easing for sure, especially over the last 12-18 months in particular. But they're definitely not back to the levels of normality that we were promised some time ago. And I think when we look at the media sector businesses that we have in the portfolio, so we have marketing services and we also have events and experiential, as Paul described it, in our current portfolio as well. And I think we've definitely seen it's very dependent on the proposition and customer that faces into. So thinking about the growth that we've seen in those businesses, regardless of that economic impact, it's really down to what is the kind of ROI or return, or what is the value that you're delivering to your end customer that has really seen us do well in this tougher economic environment.
Fraser, what about yourself?
Yeah, morning, Esther. Yeah, look, I completely echo what Emily said there. I think, 2023, especially for our clients in the advertising space, was rough, right? And I think everybody felt much more optimistic coming into 24. It's not taken off as quickly as we all hoped that it would. I think, as I go out and see clients sort of last month, this month, and going into that busy Christmas period, sorry to drop the C word in, but we're in Q4 now. I genuinely feel people are more optimistic going into this Q4, and that they're going to see some real year-on-year change versus FY23. I think, all the economic indicators are now kind of, I'm not saying they've shifted monumentally, but they're just pointing in the right direction. We talked about interest rates, inflation, etc. But I think, to put that all into context, whilst inflation obviously is now tracking down to more normal levels, it doesn't change the fact that we've been through that period of inflation. Businesses' overheads have inflated by double-digit numbers, and their revenue probably hasn't, and still isn't doing now. So we're still going to be in a kind of period of recovery, even when things tick up, because we've got to offset all those overheads that we've been beefing up, whilst revenue's been lagging behind. But totally agree with the themes that Emily touched on there.
And is that the same across different sectors and capabilities, or does it vary at all?
I think the one that jumps out a little bit to me is social. So that seems to be a little bit sort of counter-cyclical in that, if you're wanting to rein in your advertising spend, you can focus a little bit more on the bits that you kind of own yourself and sort of that cost nothing. I say cost nothing. You're obviously spending quite a lot of money getting help in running those channels, but people operating in social seem to do quite well. And I think, sorry to throw a buzzword out there, but AI is becoming increasingly prevalent, and if you're able to show a brand that you can help them deploy their spend in a very cost-effective way, as Emily talked about, that's quite powerful. And I've seen a few businesses now showcase some really fascinating tools that enable you to kind of create content very quickly to a good standard, and then deploy it at scale. So I think if you're showing that sort of capability to brands, they're more likely to steer spend your way.
What about you, Paul? Is that reflective of your clients and agencies that you're talking to? You need to take yourself off mute, Paul.
Sorry, rookie error. So I think if we look back to the annual survey event that we held last November, I think there were a couple of themes that were coming out of that. Firstly, it was around the polarization of performance in the sector. The top quartile were growing growing their top line at levels over 20% a year. They were generating a margin in excess of 20%, but the bottom quartile was struggling, and then there were the 50% in the middle, which were probably we're still finding it tough. And that very much points to points that both Fraser and Emily were making in terms of there's definitely businesses out there that are performing well, those that have got strong propositions. There's definitely parts of the market that are still growing quickly, and the evolution of marketing spend to it being online, digital first, and I guess the good and innovative tools that deliver that for clients are able to grow and perform well. I think more broadly across the client base, it's just I think the thing that still is a repeating theme is how tough the new business environment is, and that I think people are expecting client spend, and certainly that's what our client outlook survey said 12 months ago, was that we're expecting client spend to be returning in the first half of 2024, and it seems that it's actually going to be returning in the second half of the year. And I think we're starting to see those green shoots. So I think that in summary, it's probably been a harder year than people expected. 2023 was expected to be tough. 2024 was expected to see improvements, and we're probably only just starting to see that in the back in the second half of the year now.
Yeah, that's certainly reflective of my clients. That recovery just hasn't come anywhere near as quickly as they anticipated it, and obviously that ends up hitting your bottom line if you've geared yourself up for recovery that doesn't happen. What about you, Baldwin? When do you expect that sort of clients are going to start spending at the levels all of our agency clients want them to?
So, I mean, for us, the way we think about it is what are the factors that are holding back clients from spending it right now? And so here, I mean, one of the big things is interest rates, as we discussed earlier. Now, we expect interest rates to come down notably over until the next summer, and also a lot of the uncertainty surrounding interest rates to resolve over the next, maybe half a year. So this kind of interest rate issue should be solved, fairly soon. Then, I mean, there is uncertainty, for example, surrounding the budget, but there we know a lot more in a month's time, right? So these are the kind of the factors that are holding it back, where we kind of have this timeline of, when they should be somewhat resolved. But of course, then it's hard to say when exactly that will translate into actual activity on the ground changing.
Mm-hmm. And I guess, Emily and Fraser, with that in mind, how is that feeding through to sort of your portfolios and your clients' M&A intentions and your intentions to invest yourselves?
I think for us, we as a house or institution focus quite heavily on buy and build. Nothing forced, but it's definitely something that we see most of our portfolio tend to do at some point in their journey. So that always continues, and what we tend to see in periods of macroeconomic uncertainty is that actually you can have increased demand from businesses that, given they're facing the same pressures themselves, they're potentially more open to becoming part of a group and accessing some of the benefits from being part of that. So whether that's taking away some of the pressures and worries on their own, that could be accessing back office capabilities or sales function, or just having someone else to pick up the phone to when things are a little bit challenging. So we do tend to see that those volumes tend to continue. And I think, don't quote me on any of the stats here, because I'm nowhere near as qualified as Baldwin, but I think when you look at the deal volumes last year, M&A for buy and build versus new investments was pushing up. So I think that was nearly half of what the deal volumes that we saw across where we sit in the market came from add-on acquisitions versus platforms. And so that demand has definitely increased during that period. And I think, as well, as you go through these phases, and for all of the reasons that we've talked about already, as you're facing some of those stickier market conditions, you have to think about other ways to grow or to support your business as you go up. So M&A can be a way to accelerate that, rather than continue to wait for the market to recover on an organic basis. So we definitely seen that, and the intention to continue to support that is still very much there, our side.
Thanks, Emily. What about your clients, Fraser?
Yeah, I think the clients that we've got who have been acquisitive, and perhaps are very acquisitive a year or two ago, they're still hungry to find businesses to buy and to bring in. I think they're just pickier now. So, they don't want to make an acquisition for an acquisition's sake. They want to see that new capability. They want to see that new geography that comes in. So there's got to be a specific reason for it. And I think the other challenge that they're finding is, just a lack of supply, because some vendors are just kind of looking at the current market, hearing, messages like Paul just said about valuations being down a little bit, and thinking, well, I'll stick it out a bit longer then. But actually, if you've got a compelling business that is a really good fit, especially for a trade buy where they can add additional synergies onto whatever you're delivering now, there is perhaps a deal to be done. I just think we need a bit of a catalyst in the form of an upcoming budget is obviously driving some activity, so that's helping right now in the short term, although that's going to be over very, very soon. And also interest rates coming down, which is a huge factor. And I think obviously debt plays an important part in this, and that's where we tend to come in. So we're starting to see some of those things unlock that should see things pick up a little bit. But in a lot of cases, it's just been that general lack of business confidence to go out and invest or to bring your business to the market to sell. And I think there's a little bit of suspicion sometimes when a business is for sale. It's like, why are you selling it now then? The market's not great. And you need to have a very compelling story as to why now's the right time to sell your business, why it's a great time for them to buy it, just to overcome some of that suspicion that can come around when you're selling in a market like this, I think.
Thanks, Fraser. Paul, what are you seeing in the M&A market with your clients? Speak.
Yeah.
just leave it
No,
off.
done it again. Yeah. I think what we've seen is, as Fraser and Emily both described, we've seen a sell side problem for the last 18 months. For businesses that have a sought after capability that are growing, actually, I think there's the valuations have absolutely held up because there's a shortage of businesses coming to market. They're the ones where they're going to attract a lot of acquirer interest. On the acquirer side, we see strong interest and strong appetite from a very, very fragmented buyer landscape. That's what's happened and that's what's evolved over certainly the last 10 years. 10 years ago, the M&A landscape was dominated, certainly in the marketing services space, by the likes of WPP and Publicis. The number of acquisitions they're making on the agency world now are maybe a handful of deals a year, and probably Havas are the most acquisitive. The likes of WPP, they make significant acquisitions like the NCA deal, rather than acquiring multiple agents, lots of multiple agencies a year. But deal volumes haven't reduced relative to that period, and that's because of the level of private equity interest in the space. Private equity need to deploy their capital. They're looking to grow the businesses to generate their returns for their investors. It's just that not enough businesses are coming to market, and that is because of the economic conditions and how businesses are finding client spend. I think if we pull it back to what the economic backdrop has been this year, I think quite a number of businesses who were planning to go to market, certainly in this quarter after the summer, I don't think their trading has been quite as good as hoped. Their new business isn't quite as pipeline isn't quite as full as they want, so they have pushed back those sales. If you're a seller, you wanted to go to market after a good couple of quarters and have good visibility for the next few. Otherwise, you're potentially opening yourself up for a deal that's going to get renegotiated or isn't going to meet your valuation expectations.
Yeah, agreed. Mel, so bringing you in, Mike Crowe needs to come on. Big question that obviously everyone is wondering about: what's going to happen in the budget, and how's that going to impact people's M&A plans?
I wish
crystal ball time.
I wish I knew, Esther. I mean, I think it's been an interesting couple of months. Deals that were in the sort of pipeline, there have definitely been an acceleration to obviously try and get them done before the end of October, because at least there's certainty on the tax landscape. We have seen some acquirers almost take advantage, I think, in terms of pricing on transactions, saying, probably offering a slightly lower price, but a promise to be able to get it done before the end of October. So there's been quite a lot going on there. In terms of what's going to happen, I think I hope I don't, look stupid saying this, but I think I would be amazed if there isn't some tax relief retained for business owners. If we look back over the last 30 years, there has always been something, whether it's been retirement relief, taper relief, entrepreneurs relief, what we've got now, business asset disposal relief. And I think, in tax, things tend to go full circle. We run out of ideas and we almost go back to what we had a few years ago. I think I wouldn't be surprised if we ended up with something like we had in the taper relief days, where you have a business asset and a non-business asset relief, so that it could be targeted to business owners, which is obviously good for the economy and good for growth, but with those perhaps more investors and I'll call them passive investors, sat on maybe big sort of share portfolios, not getting such big tax reliefs. I have sat here before getting transactions done before budget day, only for the Chancellor to then put the entrepreneurs relief limit up at that time to 10 million. So I think the advice that we're giving at the moment is, if you've got a deal that you're happy with and it can be completed before the end of October, and frankly, if you're not already in DD, that's almost impossible to happen, then people are trying to get that completed, because at least you've got the certainty. For everybody else, I think, Paul, that we're certainly talking to, those conversations are being paused until November, because it's a case of not wanting to go to market with an uncertain tax landscape, and will the decision about when to go to market be different in November. And I think, for the sake of waiting a month or so for the Chancellor to stand up and say what's going to happen, people are almost over October just having a bit of a wait and see approach, Esther.
Yeah, I think that's definitely the right approach. Emily, how's this going to impact on deals from a private equity perspective? This sort of lack of certainty.
Yeah, I think it's similar to what Mel said. Sometimes, regardless of the outcome, and we saw this with rates as well, they were high, and it would have been great if they came down further. But just having some certainty and stability on what things might look like, rather than an unpredictability, can help. So there's lots of chatter, lots of different debating, modelling different scenarios. We've seen the exact same thing, businesses trying to close pre-October in quite unrealistic timelines as well. So we've seen lots of that, but I do think having an outcome, regardless of it, will bring a bit of stability connected to that. I think the broader thing is that some of what's in the budget may impact the broader private equity industry as a whole as well, which is causing a bit of grey hair across some of the partner bases. But we'll have to see how that plays out as well. And regardless, there is a lot of capital in the market to deploy. People have capital that they need to put out there. People need to not only do new deals, but they also need to exit some of their existing portfolios. There's a lot of businesses that are sitting in private equity portfolios now that have been in there since pre-2020. So great to have a bit more stability, and great to see what the outcome will be. But again, there's a need to exit businesses and there's a need to deploy capital. So from a private equity perspective, I do think that those volumes are going to need to come back a little bit more.
Thanks, Emily. And Fraser, what about from a debt perspective?
I hope the budget will have no impact whatsoever really on the debt side to all of this. Obviously it could impact demand and the number of transactions that are happening, but it shouldn't really alter banks' appetite to lend. I think more broadly, just to talk to debt, bank appetite, I can only really speak for Barclays, but I think I kind of speak for most of our peers when I say that in 2023 and 2024, the appetite to lend for M&A has been there the whole time, and the metrics that sit behind that haven't really shifted much. If anything, they've loosened slightly. We're in this higher interest rate environment now, so that puts things like interest cover, covenants under a bit more pressure, and means to get a deal away that we might have to be a little bit more accommodating. Maybe we were asking for 5-6 times cover, now we're asking for 3-4 times cover, something like that. So the bank is recognizing that there's a kind of a cost that can't be helped there, and trying to accommodate. As I say, the appetite hasn't really shifted. But but I think there's just been that lack of confidence from businesses to come and ask. I think about our competition who operate in this space, and most of them, I think, are as keen as ever. We're still facing stiff competition to win on transactions. The only outlier is Bank of Ireland, and some on the call might be aware that they've announced they're pulling out of the UK debt market, basically, and letting all their deals wind down now. So that's one less lender in the market. But actually what we've seen is on clients in the media space where Bank of Ireland were a lender, we've seen all the other lenders jumping in saying we can solve that problem for you. And certainly we've been doing that. I've been trawling through spreadsheets saying who's with Bank of Ireland, where can we go and lend some more money? So the appetite is there, and that's not necessarily just a plug for Barclays. But please call us if you do want to talk about that. But I think I speak for all banks when I say debt is there to be had. It's just more expensive, and unfortunately there's a base rate that sits behind that, and we can't help it.
Thanks, Fraser. And Mel, just turning to you. I mean, once we do know what the outcome of the budget is, what are the sorts of things that founders need to start thinking about and doing?
So I think the question is what should people be doing to prepare for an exit, for a sale of their business? And I think probably the key recommendation I would say is never underestimate how much a buyer in a people-led business wants those people tied in. And so what we typically see, in the not just the few months leading up to a transaction, but in probably the 2-3 years preparatory stage in an ideal world is people looking at how they're incentivizing management, whether that's through EMI share options that we see a lot of, or some other method. But I think this isn't a buyer's problem. This is a seller's problem. A seller needs to make sure early on that those key people are tied in, and in a tax efficient way as well. And that's where options are really great for that. And
Baldwin, coming back to you, what other factors are there that sort of might influence the economy over the next 12 months?
Yeah, so that's a great question. So I mean, yeah, as we said, the budget is the big uncertainty in the short term. Rates we talked about. We think another factor that, at least for us, is a big consideration right now are the negotiations between the EU and the UK, and kind of about all the post-Brexit things. And so here, I mean, just to give you one number is like the kind of the literature estimates that the cost of Brexit were roughly 5% of UK GDP. And so if by renegotiating some of the deals between the UK and the EU, we can get back some of that, that would already be a big boost. And so this is something we are looking at very closely right now. In fact, I think they started talking about this today. But then maybe more big picture is that we really think that, at least from the things, I mean, from the known knowns and known unknowns, the UK is there are relatively few events that we look at in the UK, and there's actually much more in the US and the Euro area. So kind of this relative stability or certainty right now should actually be a positive factor for the UK.
Good to hear. So then I guess just throwing a more general question out to all of you, what are your views on the outlook for the years ahead, and what should people do who are considering selling their business? Maybe going over to you, Emily, first.
Yeah, so I'm optimistic, and hopefully off the back of today's call, fine, it's not been straightforward, but everything seems to be moving in a better direction for sure. We'll wait and see how the next few weeks play out, but feeling optimistic about how that will play out. To your second question around how people go about thinking about considering options, there's lots of things that need to do that, but I think probably the biggest learning or the biggest takeaway is thinking about starting those conversations early. That's not necessarily with end investors or anything like that, but speak to people that have gone through a similar process themselves, so that you can actually fully understand the impact on you and your business as you go through that. And that might put you off doing something now, but at least you have an awareness and relationships to build up over time. From thinking about those options, the more people, the more that you can reference investors, individuals, because you are potentially signing into a relationship or engagement for X period of time, dependent on what you agree. So getting to know those early and building those relationships over time, always helpful, as and when you do then become ready to look to do something. So individuals all have capital, individuals all have a strategy, but ultimately it's people on the end of the phone that you're going to be having meetings and discussions with and helping support you and your business. So probably the biggest thing that I would say is a massive learning of businesses that we've invested in.
Do you unmute then, Esther?
Wouldn't unmute. I think I'm having a little bit of a dodgy internet connection. So what about you, Fraser?
Yeah, I think it's about having good people around you. From a banking perspective, it's not like when you come out of university and you have to kind of build up a credit history and get your first credit card or anything. You know, banks are happy to lend material sums of money to good businesses that just haven't borrowed before because they haven't had the need to do so. You just need to be able to produce really good quality management information and forecasting for us to work from. I think one piece of advice, though, if you're thinking of selling your business and you think that debt is going to play a part in that, is just to make sure actually that the business is with a bank that has an interest in doing that. You know, certain banks have more or less interest in certain sectors. You know, media is a business that Barclays is very keen on. We're certainly not the only ones. But just make sure that you're talking to your bank and that they know who you are if you're not borrowing from them now, and that they've got that appetite to do that when the time comes. Because if they haven't, you might want to start thinking about that sooner rather than later and getting to know somebody so that they can get to know you, and position themselves to support that transaction when it comes around. But, you know, I think my main advice is to get good advice from professionals like you guys, because for us, it's just about having good quality information. And if they're getting professional advice from a good accountancy firm, they'll be doing that anyway. So this selling a business tends to be something that people do kind of once or twice in a lifetime. So as the actual vendor, there aren't that many people that are kind of seasoned veterans at it, and you know, everybody needs good advice. So that's my top tip.
What about you, Mel?
Thanks, Esther. I mean, I think, you know, I've talked about sort of making sure that people are incentivized, etc. But I mean, I think what I certainly see on a tax side of things is once a deal's been agreed, things coming out of the woodwork. Let's say, so actually, you know, standing back a year or two beforehand, saying, you know, have we got everything in order? You know, are we going to be able to stand up to diligence? And that's not just from a tax perspective, but, you know, from a legal perspective and finance perspective. Have we got employment contracts for everybody? Can we find our lease? Can we all of that sort of thing? So actually the preparatory work to actually go through that transaction, I think exactly to what Emily said, you know, talking to people that have done it, that can explain how much of your life it just takes over, and being able to do a lot of that work and get the support around you before you go into a process would absolutely pay dividends.
Yeah, totally agreed. And what about you, last but not least, Paul?
I think firstly, just in terms of our view on the next few years, is we're certainly optimistic. If you look at there's been significant levels of uncertainty since 2016 probably now in terms of the market, and yet both in terms of the media landscape and the level of transactions, it's been a pretty decent period. Hopefully things will become more stable over the coming years. Interest rates are on the way down, and certainly there's a lot of very clever people doing very, very innovative things in this sector in particular, and that will lead to investment, that will lead to new partnerships, new transactions taking place. So we're definitely optimistic for the years to come. For people that are looking at selling, it's similar to the points that Mel and Emily were making. Do it with purpose. Get sale ready. It's a very long process. It can be a very long process. It shouldn't be. Ideally, it's over a contained period of time, but sellers shouldn't underestimate that. So they need to make sure that the business is still growing sustainably into the future through the process and beyond. There's likely to be an earnout on the majority of deals, so you need to make sure the business has got the runway to keep growing. Make sure the second tier is incentivized, as you say, and to Fraser's point around the quality of the management information, that is really, really important. If you can't tell a buyer your P&L to the end of September within a couple of weeks, which you'll be amazed at how many people trying to sell a business can't do that. It causes challenges. It stretches transactions. It makes the buyer more nervous about the quality of the business they're buying. So take all of those necessary steps to make sure that you're ready when the time comes.
Absolutely, and when the time does come, I think just make sure you've got a small team focused on the transaction and don't let it distract everybody, because at the end of the deal you still need a functioning business with a strong new business pipeline to maximize your earnout. So thank you all so much. That was really, really insightful. I'm sure the audience have found that really, really useful. Remember, this session was recorded, so please do share it with anyone who wasn't able to make it today, and please do fill in the feedback form that we will send to you afterwards. Please join us. We're holding a webinar on the budget and its effects on the media industry on the 5th of November. So please join us for that. And also we've got our survey seminar, not webinar, seminar, in-person event coming up later in November. So it's the 27th of November. It's in the evening. We're holding it at BAFTA again, where we've held it for the last 3 years. And that's a survey where we look at the financial performance of over 200 companies even, across the marketing services sector. And then we look at all the various different disciplines, whether it's advertising or digital or PR or media buying, whatever it is. And we look at all the key KPIs. So it'll be our 31st year or something similar of doing that. So please do come along. It's generally a very well attended event and a good chance to network and catch up with some of your long lost peers as well, and have a glass of wine afterwards. So thank you very much for joining us this morning. Enjoy the rest of your day, whether it's drizzly and miserable or whether the sun is shining. Thank you very much.